Just because a stock is cheap does not mean it's a good business. And we want to be in the business of buying good businesses, right? So you, dear dividend investing viewer, are going to get a glimpse of 5 fundamentally strong dividend paying companies that look cheap using dividend yield theory. They have a simply safe dividend score of very safe, dividend yields over 2.5%, and pretty dang fast dividend growth. Hey, what's up? Welcome back. I'm Russ, a welder who is passionate about passive income and sharing ideas with you to explore and see if any float your boat. So this is in no way, shape, or form investment advice. So dividend yield theory is a way to tell if a stock is cheap or pricey for mature and steady companies. And it says that the dividend yield of a stock usually goes back to its normal range, which changes the stock price as well. So if the yield is higher than usual, it might go down, which means the stock price might go up. Now this is not always true, and there are other things like earnings and competition that can change the stock price too. But dividend yield theory can definitely help us try to find some cheap stocks that also pay us well. You can always pause the video to look at some of these 10-year trends a little bit more in depth. And don't forget to just tap the thumbs up. First up is Hershey Company, which is a sweet deal for you chocolate lovers. It makes and sells all kinds of candy, snacks, and pantry items under famous brands you know like Hershey's, Reese's, Kisses, and Kit Kat. Hershey was started in 1894 by a guy who dropped out of school in 4th grade and learned to make caramel. And now it's one of the largest confectionery companies in the world. And did you know that Milton Hershey almost boarded the Titanic but changed his plans at the very last minute? As of this recording, Hershey has a dividend yield of 2.5%, dividend safety score of 93, very safe, 10% 20-year compound annual growth rate, and they last grew the dividend 15% in July of 2023, and they've been paying that dividend uninterrupted for almost 100 years. They'll be handing you out $4.70 per share every year currently, and their dividend yield is 24% above the 5-year average of 2.03%, and their forward PE is way the heck below the 5-year average of 24.3, and we currently find them buried toward the lower end of that 52-week price range. Free cash flow payout ratio only 54% the trailing 12 months. Free cash flow per share just up and to the right. Although their earnings per share growth is expected to take a huge hit next year, we'll see if that comes to pass. They slowly buy back shares down to 206 million shares outstanding. Outstanding margins here with 54% return on equity, 27% return on invested capital. Remember, the ROIC is the capital that's floating around inside of a business that they're going to put to use, takes into account the shareholders' equity and the debt, and 15 cents of every dollar coming in the door in sales is making its way down to free cash flow per share. Hershey's net debt has been trending down to 55%, which is just awesome, and their $16.42 of operating income can easily cover every $1 of interest expense on their debt. At number 2, we've got EOG Resources, which is an energy company that drills for oil and gas and mainly operates in New Mexico and Texas. Now, EOG used to be part of Enron but became independent in 1999. Fun fact, EOG stands for Enron Oil and Gas, and they do have a dividend safety score of 82, very safe. 5-year dividend growth streak paying uninterrupted for 31 years, 24% 20-year CAGR, currently paying $3.64 per share. They've had a couple special dividends in 2023. Their dividend yield is 26% above the 5-year average of 2.52%. They have a free cash flow payout ratio of only 34%, so very, very low for EOG. And that $9.72 of free cash flow per share can easily cover the dividend of $3.64. Negative 18% sales growth the last 12 months. Now they have diluted shareholders just a little bit, up to 585 million shares outstanding. You can see the cyclicality of their sales. Remember, they're in oil and gas, so it's not going to be like a Hershey's just solidly up and to the right. Lately, they've had really nice margins with return on equity at 31%, ROIC at 27%. 24 cents of every dollar of revenue is making its way to the free cash flow, so that's very nice. And currently, they have no net debt according to Simply Safe Dividends and an interest coverage ratio of $63.83, which is just strong. Next, we got M&T Bank, which is a financial institution that offers banking products and services to individuals, businesses, and communities. It has more than 700 branches in 12 states and provides you everything from checking and savings accounts to loans, investments, and insurance. M&T was founded in 1856 and is one of the 20 largest US-based commercial banks and has been profitable every single quarter since 1976. Oh, and by the way, M&T stands for Manufacturers and Traders. M&T gets the highest honor of a dividend safety score of 99 and a current yield of almost 4%. 34 years uninterrupted dividends, 6 years dividend growth streak. Check that out. 8% 20-year CAGR, 8.3%. They last grew that dividend in February of 23. And M&T is paying you $5.20 per share. And it does look like they're about to have another dividend increase. So we'll see if it keeps with that 8 to 10% area. M&T's dividend yield is 29% above the 5-year average of 2.99%. And they're smack dibbity dab in the middle of their 52-week price range at $135.29 as of this recording of this video. As Simply Safe reminds us that it makes more sense to look at a bank's earnings payout instead of the free cash flow. So earnings payout ratio only 31%, but still they have really nice free cash flow per share, earnings per share, sales growth 38% the last 12 months, although the earnings growth has taken a little bit of a hit, which is likely why we've seen the share price not be at the top. Now, do be aware, they've done a little bit of diluting up to 168 million shares. We would need to dig into it and find out exactly why M&T wanted to bring in the extra money with the shares and what they're using it for. Return on equity is in the low teens, high single digits, not the greatest, but not the worst, and their net debt to capital, 34%. In the number 4 slot, we've got NextEra Energy, which is a big player in the power business, and it makes and sells electricity from different sources like wind, solar, nuclear, coal, and gas. NextEra also builds and runs projects that use clean energy, such as batteries and transmission lines, and has a lot of power plants, wires, and substations across North America. Now, they serve about 12 million people in Florida, where it started in 1925 as FPL Group and changed its name to NextEra Energy in 2010 and is now the most valuable electric utility in the United States. And did you know? NextEra Energy is the world's largest generator of renewable energy from the wind and the sun. They get a Simply Safe dividend score of 90 with a yield of 3.08%. And Simply Safe has a note here, they did downgrade them a few points in September of 2023 because, as they say, there's an anticipated slowdown in the renewable asset sales, so something to be aware of. Now, they have 27 years of dividend growth, a 9% 20-year CAGR, 10% they raised it in February of 2023. So they too are getting ready for a dividend increase and currently paying $1.87 per share per quarter. NextEra's dividend is 43% above the 5-year average of 2.15%. Some of those headwinds have really been dragging them down, but also it's the interest rates, right? As those were going up, it sucked away a lot of those yield-seeking investors. So could be a good time to get into NextEra Energy at $60 a share, where it currently is. And similar to the banks, we want to look at the earnings payout ratio because they're so capital intensive and they have to build out those projects. So their earnings payout ratio has just been steady Eddie in the mid to high 50% range, currently 58% the last 12 months. And earnings per share just keeps going up and to the right. That's what you get with these utility businesses. But their sales growth did jump 38% the last 12 months. Now they too have been diluting shareholders to grow the business. That's just kind of the game that you have to play when you're one of these big utility companies, but the sales have been flat, but they're starting to increase now. Now their margins could be a little bit better, but there's nothing spectacular. This is almost like guaranteed monopoly money that you get with these utilities. Net debt ticking up a little bit to 56%, and their interest coverage ratio could be a little better in my opinion, but it's come down to $4.63. And last we have Rexford Industrial, which is a real estate company that focuses on industrial properties in Southern California. Now they buy, operate, and improve warehouses and factories in areas with high demand and low supply, which is their unique strategy that allows them to grow and create value. Rexford owns 371 properties with about 45 million square feet of space for different kinds of tenants, and they trade under the ticker REXR. And in 2023, Rexford Industrial closed $1.5 billion of investments despite their sector's correction. So for a REIT, pretty good. They get a dividend safety score of 81 with a yield of 2.77%, 9 years of uninterrupted dividend growth, 17% 5-year CAGR. They last raised it 21% in February of 2023. So they also are getting ready to raise that divvy again, paying $1.52 per share. Now remember, it is a REIT, so it is a non-qualified dividend, meaning you will pay your ordinary income tax rate if it is held in a taxable account. Their dividend yield is 46% above the 5-year average of 1.90%. They're in the middle of their 52-week price range, so there could still be a little bit of a bargain left on that. Now, I don't like to look at free cash flow payout ratio for a REIT, so we like to use adjusted funds from operation, or AFFO, which is currently at 86%, so it's a little bit high, but is projected to drop to 79% in the next 12 months. And their adjusted funds from operation is going up and to the right like clockwork. We like to see that. Now the bugaboo with REITs is to remain a REIT, they have to pay out so much of their money in dividends that they're going to have to bring new money in one way or another, and they usually do it through issuing new shares, which you can see that they've done here, all the way up to 197 million. But when they do that, we like to see the sales going up and to the right, which it has followed that trajectory, and as has the adjusted funds from operations per share has done that. So really, I don't see much of a problem there to grow the business. So the margins for this REIT look pretty good. Return on equity could be a little bit higher, as well as return on invested capital. But we like to see this high operating margin, and their net debt is very, very low for a REIT, 21%, and they have plenty of interest coverage ratio. So definitely one of the stronger, less talked about REITs out there. So we want you, dear dividend investing viewer, to share with us in the comments below if you are interested in any of these. Did any of them float your boat? Or tell us what stocks you're buying and you think are cheap or fundamentally strong, or whatever the hell you want to tell us in the comments below, because it's your world and we all live in it, boss. And if you are a cheap stock video junkie, well, in this floating little box next to my head, I have another fix for you. And if you want that fix, click on that floating little box next to my head, and I'll tell you which 3 cheap stocks they are there.